Hey guys, I'm Joseph Graff from the Investing with Joseph and Alex Graff YouTube channel. Make sure to subscribe to the channel if you haven't already. My brother's going to be coming out with some pretty cool technical analysis in the upcoming weeks, and you want to make sure you've subscribed so you'll be able to watch those videos as soon as they come out. So today we're going to be talking about how to pick the stocks to invest in. So the first thing you want to think about when determining what stocks to invest in is you want to think about your investing goals and your time frame. If you want to invest in the stock market just to make a little extra money to make a down payment on your house in a couple of years, like 2 or 3 years from now, your investment strategy is probably going to be a lot different than if you're investing for retirement, which could be in 50 years. So after you've given some thought to the time frame and your investing goals, what I like to do is I like to look for products and services that I use on a daily basis. So I'll give you all a couple examples. So I have an iPhone. iPhones are made by Apple. There's an example of a product that I use on a daily basis and the stock symbol associated with it. Another example would be Google. I use Google almost every day. I do use it every day. So there's another example of a company to look at. You can also look at stuff like grocery stores, and just anything you can think of. If you use their product or use their service and you like their product or service, then odds are there's a good chance that you'll like investing in their company. So the next thing what you should do after you've identified companies whose products you love is you need to see if their price looks reasonable. So the way that I like to do this is I like to look at a company's price to earnings ratio. This is not the end-all be-all way to measure the value of a company, but it does roughly give you some idea. So the way I kind of like to think of it, and some people would agree with this approach and some people wouldn't, is that if a company has a price to earnings ratio of let's say 20, that means for every dollar you invest, you would expect to see them to have earnings of 5 cents. So in other words, you're looking at a return of 5%. Now, this isn't exactly how it always works, but like I said, it's a good way just to get a general idea of what the stock is worth. It's really good to see whether it's a growth stock, a high growing stock, or if it's a maybe a value stock or a kind of more stable established company. So as I've said in previous videos, usually if the PE ratio is lower, it's considered more of a value investment, whereas if the PE ratio is higher, it is considered to be like a growth stock. Something else I like to look at is the price to book ratio. Now what this is it measures all the assets that a company has, and then determines the price that you're paying for that fraction of the assets. Pretty much every stock will have a price to book ratio of over 1. And this is because a company that has a price to book ratio of 1, what that means is if that company was to go bankrupt today, you would receive all your money back. When the company liquidated all of its assets, your share of the assets would reflect the amount that you paid for the stock. Now, bankruptcy is a difficult and complicated process, so that's not always exactly how it'll work, but hopefully it gives you all some idea of what the price to book value ratio measures. So the next thing I really like to look at is the price to earnings growth ratio, and what this is it's a measure of the forward earning potential for your stock. So it reflects you know, the price given the future earnings projections. And this is just another good way to see, you know, what the approximate value of your asset, you know, should be in the coming years. The next thing I like to do is I like to compare the stock that I'm considering buying to other stocks in its sector, and you know, if you can, it's direct competition. So for a company like Google, I'd probably compare them to Amazon. For a company like Kroger, I'd probably compare them to Target and Walmart. And now what I do is I'd look at, you know, both of their price to earnings ratios, price to book ratios. I'd probably check out dividend yield if there is one. And, you know, just in general, try to get a general idea of each company's price. You know, I'd also try to read any sort of analyst projections, just essentially get myself as familiar as possible with the stock. Make sure I'm not going to have any surprises when I buy the stock. You know, hopefully this stock is not about to go bankrupt, or you know, they've been having declining revenue or sales over the past few years. I just want to make sure that they're a good company with the potential to grow in the coming years. Now, once I've analyzed all this information, I usually try to get an idea of what I would like to buy the stock at. And this really is not an exact science. A lot of it's based on your time frame. So, for example, let's say I wanted to buy Visa stock. Now, right now, I think that in the short term, Visa is a bit overbought. I think its value has been inflated to the point where I'm not sure that it is you know, worth it to buy more shares right now, because I think there's a good possibility in the coming 6 months or year that it could go down in value. So if my investing time frame is a year, I probably wouldn't want to buy Visa. Now, on the other hand, if I was investing for let's say 40 or 50 years, I would be completely happy with buying Visa now, because I think over the next 40 to 50 years, I think Visa has a great opportunity to grow some more and appreciate in value, and I think it'd be a great investment. So like I said, your time frame for investing these stocks is important. So what you want to do is you want to set a price target, and basically if your stock dips below that price target, you want to buy that stock. Now, that does come with the stipulation that there should be no major news, anything that scares you about the stock. Maybe there's some big news that, you know, just really scares you away. In that case, obviously, don't buy the stock. But for everything else, once your stock dips below that buy target, go ahead and buy it. Now, as soon as you buy this stock, you want to set a sell target. Now, here on this channel, I generally preach investing for the long term. I think the longer you invest, the longer you hold your investments, the more likely you are to make money. But, you know, there are certain cases where if you see a stock appreciate significantly right away, then it may be a good idea to sell it and use that capital for other investments. So like I said, you want to set a sell target. And basically that's just in case the stock jumps up higher than you were expecting and you can turn a quick profit. Okay guys, well that about wraps up today's video. Like I said, make sure you hit the like button if you enjoyed this video, and make sure you subscribe to this channel so you can see my brother's technical analysis coming up in the future, as well as some more fundamental analysis videos and just general tips and info videos coming from me.